Um, and again, San Diego North EDC, for those that don't know, is an economic development organization. We're the only one that works in the northern third of San Diego County, and our core mission is to market the region for inward investment, work with existing companies to help them retain and expand employment, and connect employers and educators to strengthen our workforce pipeline. We do a number of these educational webinars during the year, and we're excited to bring this one to you today. We've got two presenters today. First, Jessica Dorset. She is with Magnus Blue as a tax advisor and a CPA. She graduated from the University of San Diego with a bachelor's in accountancy in 2005, and she has worked at the firm since graduating, working through a number of roles there, including the leadership roles, and has now, with her husband and Brett, are raising their three children and volunteering in a number of areas. And then also joining us on the webinar is April Kriz. She graduated from Cal State San Marcos, go Cougars, in 2008 with a bachelor's in business with an emphasis in accounting, spent a number of years in banking, and is raising her four children, Autumn, Kyle, Tyler, and Justin, here in North County. With that, I'm going to turn it over to Jessica to run through the slides. And again, this will be presented and put on our website and our YouTube channel later today. We will take questions. You can either put them in the chat or use the hand raise if you're more comfortable speaking out loud. Please mute yourself during the presentation so we don't have crosstalk. And with that, I'm going to turn it over to Jessica.
Great. So, hold on. All right, good morning, everyone. Oh, no, you cannot see this. Sorry. Perfect. Except for I lost mine. Shoot, what happened? I apologize. This was working. We tested this. Try this way. Now we're good?
Yeah, now we're good.
All right, thank you, April. All right, good morning, everyone. Sorry about that. Okay, we're gonna jump right into it. So last year, 2023 calendar year, while we were working on the 2022 tax returns, one of the biggest, I guess you can call it a surprise, it's not that we didn't know it was coming, but we just thought it would get stopped, was the tremendous change to the research and experiment deduction rules. This is referenced as the 174 deductions. So what happened was this came out of the Tax Cuts and Job Act in 2018, and it was supposed to go into effect for 2022. Everyone in our industry honestly thought that it was going to get delayed or reversed. We thought Congress would do something about it. Unfortunately, they never did. So we actually ended up scrambling towards the end of our tax season. So summer time frame, we realized this wasn't going to get fixed and we had to implement it. So we're going to go through it and I'll tell you about some possible changes on the horizon. So any business that is involved in any sort of research and experimental type activities needs to be aware of this. You'll notice I didn't call it research and development. Originally I had, but that wording is specifically for the credit, whereas for what we call the deductions, expensing these expenditures is specifically to research and experimental type activities. So before 2022, any business could expense all of these expenses right away. It had the deduction part of research expenditures is completely different than the credit part. Okay, so whereas before 2022, we really didn't try to specify a difference between them. Now we really have to be mindful in separating these two ideas. We would not have to capitalize anything, but if we did capitalize it, sometimes people would maybe make their own software, for example. you would probably capitalize something like that, and if you disposed of it later, you would just write off the whole asset as a loss if you hadn't already fully depreciated it. Let me see, I have a typo here. I'm sorry. The R&D credit, I shouldn't say R&E, I'll fix that. The R&D credit was available at that point in time with very little documentation reporting requirements that went to the IRS. If you used a consultant, oftentimes you had a lot of documentation on your end, more as put in the files in case you're ever audited on it, but you didn't have to submit a whole lot when claiming those credits. Starting with tax years after 12/31/21, basically any tax year that starts with 1/1/22 moving forward, all we're going to call them specified research or experimental expenditures, we call them SREs, must be capitalized and amortized over 5 years. What that means is you don't just deduct all of those expenses right away. You capture them all, put them as an asset for tax purposes only. Side note, this does not impact GAAP and this does not impact the state of California taxes. This is a federal tax issue only. And you amortize it over 5 years if they are US-based expenses, or if they're foreign-based expenses, if you've got these types of activities going on in some other foreign country, you have to amortize those over 15 years. Additionally, the first year that we call a mid-year amortization, and I'm going to go through an example in the next slide of how that looks. Another whammy on this is when you did dispose of these activities, maybe you completely abandoned some sort of research effort on year 2 or 3, we don't get to just write off everything that was not yet amortized. You have to keep amortizing it over the 5 or 15 years, respectively. The R&D credit is still available, but there is a limitation based on the amortization that you're taking. So while the R&D credit calculation hasn't changed itself, its limitation has changed because of the way the expenditures are now happening. And then starting as of January 10, 2025, so next year, any R&D credit amendments to prior years would require significant amount more documentation and a sworn declaration. This is kind of a big one. What would happen is a lot of R&D consultants would come into a business and say, oh, you've missed the last 3 years of credits. We're going to go and amend all the open years so you can get that money back. Great. But now those amended returns will have to have a lot more information on it and this sworn declaration. I think they're really trying to go after fraud and abuse here. So here's a really simple calculation. Let's say your business on the first year has SRE expenditures of $630,000. Again, previously you would have deducted that entire amount in the year that you spent it or accrued for it, however your taxes worked. But now you would have to take that entire $630,000 and what we call capitalize it and amortize it over 5 years if US based. So if we divide that by 60 months for the 5 years, your monthly deduction is $10,500. And then the first year, you get 6 months of that. So you would only get $63,000 of amortization deductions as compared to previously you would have deducted the full $630,000. This is a small business killer. We had a few of our clients that had to take significant hits because of this last year who implemented it. That is why we were really surprised to see that it didn't get fixed or didn't get addressed. There were several bills that had come up, but just couldn't get through. Either this part would get taken out or the bill itself died. So this next slide talks about what's included and what's not. This is where if you're used to doing an R&D credit, you have to get that whole thought process out of your mind. They are not the same conversation. They are not the same expenses. You look at your contracts completely differently. So it's important to not get confused with the rules of the R&D credit. The research, the research and experimental expenditures are going to include your costs of labor, which include performance, supervision, and obviously your indirect type activities. cost of contractors involved in these activities, cost of materials, any sort of recovery allowances such as depreciation of property used in the activity, but it does not include the amortization of what we just talked about. Certain overhead allocations would need to be applied as well, and travel costs. We do not include most of the G&A type expenses unless it's a part of that overhead allocation. You don't have to include interest of any debt financing of these activities. Website costs, quality control costs, patent costs are not included, advertising, things like that. But what I would say is important is to realize that whatever type of contract you're working on, whether this applies to whether this is internal research expenditures or contract related, client customer related. And it doesn't matter if your contract is a cost plus or a ton of materials. That conversation is irrelevant, whereas it's 100% relevant for the credit itself. What has happened since the beginning of the year is we had the Tax Relief for American Families and Workers Act come through the House. And there are several tax changes in that bill that we're going to touch on a few slides here. It's gone through the House. It's now with Congress, or sorry, the Senate. And if it passes the Senate, it would have to go to the president, obviously. It does have bipartisan support, so there's a good chance it'll go through. If it does, as currently stated, it would only delay implementation until 2026. It would not get rid of it completely. Additionally, it only delays it for expenditures that are US based. So any foreign based research and experimental activities would still have to be capitalized and amortized over the 15 years. For if this does pass, any companies that did implement for 2022 likely would have to go back and amend their returns to reclaim those deductions that they lost, unless the IRS does something about that, which they may or may not. Next, we're going to talk about the employer retention credit. It seems to never go away. The IRS did pause processing on new claims in September of last year because they, one, had a huge backlog, and two, were really concerned about a significant amount of fraud. I'm sure everyone on this meeting has had phone calls, text messages, commercials galore, seeing, all of these little pop-up businesses that are trying to help these consultants, trying to help businesses claim this credit. Many of those are fraudulent. And the IRS is aware of it, and it's something they're trying to address here. The current deadline to file claims, if you haven't yet, would be April 15th of this year for the 2020 tax year, and then it'd be April 15th of next year for the 2021 tax year. And the 2021 tax year, or sorry, calendar year, I should say, calendar year for payroll taxes, that was the more lucrative credit. 2020 wasn't as lucrative. So the IRS is developing a withdrawal program for the improper claims that are out there, where you can settle if you self-report, pay back like 80% of the credit. So you'd still be able to keep 20%, but they're trying to encourage people to, maybe they realize they really kind of were scammed into this program by these promoters, to go ahead and self-report that. Another thing to note is, when you got these credits for for-profit companies, so nonprofits are definitely a little bit different because they don't pay income taxes. For-profit companies actually needed to go back and amend their 2020 and 2021 returns that correlated to those payroll quarters that the credit was reported on, because you had to reduce the deduction on the wage deduction on your return for that credit that you received. The IRS was very clear on that. You didn't pick this up on the year you received it, the refund. You had to go back and amend those income tax returns. The IRS has acknowledged that they have been very slow in processing these claims. And so I've seen the adjustment notices come through where they've not assessed the penalty for the late payment of the taxes that are then due because of it. But if you were to be assessed late payment penalty on the taxes, there is relief available for that based on reasonable cause. Interest is still gonna be charged, so you're still gonna have to pay interest on it, but you could at least get abatement on the penalty if they charge it. And then just a quick reminder as well, there is no taxable event in California for these credits. So if you are going back and amending the 2020 or 2021 returns to pick up the ERC credit impact on the federal return, make sure your preparer is not also amending California. We've seen a few come through on that on like new clients where they were, and it's a tax you don't have to pay. So just kind of a side note on that. The only ones who would possibly be affected by it would be sole proprietors. Okay, so then we wanted to talk about the bonus depreciation in section 179. Just a quick kind of, this is when you buy capital assets, you know, your furniture, equipment, certain vehicles, things like that, and you're able to take up until this point, you're able to take like 100% deduction for that via the bonus depreciation and or the 179 expense. For the calendar year 2023, that bonus depreciation, which has been 100% for quite a while now, is now limited to 80%. So if you bought an asset for, you know, $1,000 that you capitalize, instead of deducting $1,000 in bonus depreciation, you're only going to get the $800. Next year, that's supposed to go down to 60, and then you can see the progression reduction going on there. And in theory, you're supposed to take the bonus depreciation before you take any 179. So the 179 expense is actually a completely different tax code, which is why we reference them differently. 179 expense also allows you to take 100%, you call it depreciation on the asset, but there's different limitations in place. So there's a maximum amount, for example. Obviously, if you're spending over $1 million on assets, you're a very large business in 1 year. And then there's limitations, like if you have a loss, for example, a tax loss, you can't take the 179, and there's also a maximum spending amount. Where there are times that you don't want to take these accelerated depreciations, might be, you know, if you kind of, if you know you're in a loss situation for the year, you may want to have that more stretched out amortization over the life, because you don't necessarily need the deduction this year. And the funky rules of the NOL kind of play into that. And we actually have another slide on that. The new bill I just mentioned also addresses this. So it would bring that bonus depreciation back up to 100% through 2025. And then for the tax years 2026 and 27, those would, sorry, calendar years, there's a difference there. Calendar years 26, 27 would then kind of flop right back to that 20 and 0. So you would lose that laddering reduction there, but you would get the full 100% through 2025. And then they also have proposed an increase to the 179 deduction for 2024 to be 1.29 million instead of the 1.22 million. So this concept, the excess business losses, is not new. This also came through with the TCJA Act, the Tax Cuts and Jobs Act in 2018. But I've seen it coming up again a lot with clients, and it's been like a surprise because we're kind of used to talking about net operating losses, but we're not necessarily used to talking about the excess business losses. And I thought it would be a good time to just sort of do a quick refresher on it, so that you can plan for it if you need to. This only applies to pass-through entities, so this is your S corps and your partnerships. But what it does is if you have a loss, let's say you have $1 million loss in your K1 that comes to your personal return, right, for a pass-through entity, you are not able to utilize that full $1 million loss against other income on your individual return. It's limited to this $578,000 for 2023, for example. And that's for joint filers. That's cut in half if you're single or married filing separate. It becomes a shock because sometimes people have these, you know, like maybe a major income and some other source, and then they think, okay, I've got this really large loss coming from my other company, they'll offset, no harm, no foul. And then all of a sudden it's been limited. And they kind of are scrambling to address it. It does carry forward as a net operating loss, but it's just something to kind of be aware of, because I've seen a few tax clients get surprised by that. The other thing, as a reminder, is the net operating losses can only, when they carry forward, so if you have a loss in a year, that net tax loss carries forward to offset income in future years. You can actually only offset 80% of your taxable income in a future year. So if you have this large NOL coming forward, and maybe your next year you've got $1 million profit, and you're like, great, I have $1 million net operating loss, I'm not going to pay any taxes. Well, not quite. You can actually only offset 800,000 of it. You're still paying taxes on $200,000 of income for federal purposes. And this is true for corporations and individuals. So it's something to kind of be aware of. And that's where that depreciation planning might come in. You don't want to take a whole bunch of bonus depreciation and have this massive loss, carry it forward. You can't even use it all. And now you've got no depreciation deductions because you used all the bonus. There's a timing thing to be aware of. So the next few slides April's going to discuss. Some of these are actually a repeat from a presentation we did in November of 2021. So Eric's going to pop in a link to that presentation in the comments. We're going to kind of breeze over these just because we have gone through them in detail, but we thought we'd include them because they are still kind of new. So we'll go ahead and pass it over to April.
Good morning. Yeah, so first we have the qualified commercial clean vehicle credit. So this is available for businesses. It can reach a maximum credit of 40,000 if the vehicle weight was over 26,000 pounds, but typically it's less than 14,000 pounds, so it's a maximum credit of 7,500. These are credits, they can be applied to used vehicles as well. The problem with that is it cannot be used if the used vehicle was already got a credit claimed against it. And unfortunately, right now, there's no real way to verify if that vehicle had already had the credit claimed. So it's hard to figure out for the used vehicles. But for new vehicles, this credit is available with different standards in place as far as if it's a qualifying manufacturer and things like that. So just to be aware that when you're gonna go purchase a vehicle, make sure you talk to your advisor first. There is VIN number lookups that we can check just to make sure that vehicle is qualified and will get you the credit that you're expecting. And then just make sure too, the vehicle does have to be subject to capitalization. And then that cost that you paid for the vehicle needs to be lowered by the amount of credit you received to depreciate the remaining balance over its useful life. And then if you get rid of the vehicle that's subject, or if the vehicle becomes no longer qualified in your business, the credit is subject to recapture. We can do the next, yeah. So then there's the energy efficient commercial buildings deductions. So these are available. This is a deduction. Important to recognize that a deduction is different than a credit. Like the previous slide, it was a clean vehicle credit. A credit is immediately taken off of your tax liability. So into the tax return, you owe this much, credit immediately decreases it by that amount. Versus the deduction is up, once you figure out your AGI or the net income, a deduction comes off of that and the remaining is taxed based on the tax rate. So with this one, the energy efficient building deduction, it's only available on 3 different systems for your building that you may own or lease. It has to do with interior lighting systems or the HVAC system, the AC, heating, or the building's envelope. So the, kind of exterior windows, things like that. The base calculation, you can get up to $1 per square footage, depending on if the systems are qualified for the deduction. And then if you meet certain wage requirements, wage and apprenticeship requirements, that can go up to $5 per square foot. But that is if you have certain, labor activity hours recognized and other type of prevailing wage put intact. So again, you want to talk to a tax advisor to see before you purchase these systems, if you're thinking you're getting a credit, just make sure you find out that you really are going to get that deduction before, making those big purchases.
And it's a conversation to have with the contractors doing it as well.
Yeah. Then we have our famous PTE. And now this has been a big deal for the last couple of years. Why this came about is there is a limitation on individuals for what we call the SALT limitation. SALT is your state and local taxes. So those high real estate taxes that we pay are limited to $10,000. So in order to get around this, they decided, well, you know what, let's let businesses take this credit and then it'll pass through to the owners of the business. So in order to take this PTE, you have to pay 9.3% of your net income from your business income. So, and these have to be paid by very specific times and it has to be the full amount. There isn't any like leniency.
Requirements for the type of HVAC methods.
Oh. So it doesn't make sense for everyone, and it's something that it requires some tax planning through to decide if it is going to be beneficial, because these payments are not just directly refunded. They carry forward for 5 years only. So you just want to make sure that it's something you are going to be able to utilize, and it's going to make you're going to see a benefit on your personal tax return for it. So typically you have to pay at least 50% of your prior year's PTE payment if you made one, or $1,000 if it's your first time electing the PTE pay through. And just note too that when you do your tax return, if you have a credit carryover, it does carry forward. It's not immediately refundable. So you can't just get it back, and your other credit for your tax liability, let's say you do have a refund, you can't just say, oh, okay, yeah, put that to my PTE. It doesn't work like that. It only goes for, they're very separate things.
So just to be clear, the payment is made by the S Corp or the partnership, and it comes through on your K1s as a federal deduction. And then on your California K1, it's a tax credit. And so that's where we're able to push through this deduction on the federal return, because previously to this limitation, S corporations and partnership owners would make, you make all these tax payments on your individual return. Your state tax payments would be a deduction on your Schedule A. So with this limitation, it was like an unfair penalizing of the small business, these business owners. And so that's why they put this through, and many states have adopted this. But I just wanted to be kind of technical. That's how the deduction comes through, and that's how your credit comes through. Okay, so multi-state, I know I keep bringing this up every presentation, but I feel like it needs to be. In our world, our world, it just keeps expanding. So as we have more and more remote workers, we do business with more and more businesses outside of our home state, our taxing state. This concept of nexus, where you've got potentially tax liabilities or tax reporting requirements in other states, is going to grow and grow. It is something that is really being talked about amongst the states. The old kind of laws are sort of antiquated and don't really fit today's environment. So I just want to make sure people are kind of aware of it. There are certain things that trigger, if you're used to just only paying tax in California and you do all your business in California, great. But if you've got employees outside of the state, those employees, more likely than not, are triggering a nexus thing where you would have to file a tax return in the state that those employees work in. Certainly if you have any offices or a sales team in another state, maybe, you've got another office in Texas or something like that, you're going to have that triggering event. Revenues. So this is kind of the one where I feel like this is going to start really catching up to us. Service-based industries, where are your customers? Are your customers in California? Or are you providing a remote service to customers, across the United States, for example? You need to be tracking where your customers are. Where are they receiving that benefit? And if the benefit of your services are outside of California, there's a good chance you have nexus in that state. Now, each state is different. This is a really difficult part of tax law. If you are a small business, you do less than a couple million a year, I'm not really too worried about it. But if you're doing, 10, $20 million a year in services and you've got customers all over the country, it's something you probably should start looking at. Sales of tangible items currently are protected by this public law 86-272, but that is a really old law that is being heavily attacked right now because of what we just talked about. It's so easy to jump online now and buy something from a business in another state. To get access to that, you don't have to have that salesperson going door to door or get the catalog. It's so easy to do that. So the states feel like they're missing out on revenue because of it. Sales tax has already been addressed here. Like, we're talking income taxes. Sales tax was completely changed by the Wayfair case you probably heard about. That's why now Amazon, like if you order anything on Amazon, you're paying sales tax to California, even though maybe the person's technically selling it through Amazon is in another state. That totally changed that rule. So each state is different. Each state establishes different nexus being how to determine if you have a filing requirement in that state, which could be a completely different set of rules on how they actually tax income in that state. So there's a lot of information to know. It's just something I want people to start really being aware of. There could be some planning opportunities. There could be a situation where you actually pay less than 100% taxes, or pay tax on less than 100% of your income because of the way states tax. So there could certainly be some planning opportunities there. Okay, so this next slide is actually really, really important. So if you've dozed off, please pay attention now. This actually isn't tax at all. This, though, is something we want everyone to be aware of. This is a new reporting requirement. It's called the beneficial ownership reporting. Any new business that starts effective January 1st, 2024 has to file this report. So basically any entity that registers with the Secretary of State, right? You form a new corporation, new partnership, LLC, whatever. You file organizing documents with the Secretary of State. You then also need to do this FinCEN reporting, which identifies the owners and certain related persons, officers, those who exercise control. It's more than just what we see on the tax return. So for example, if I started a new business, I've got to give them all the information on myself, my husband, if I have any other officers that I've appointed, any other certain related persons, and there's a laundry list of it. You have to get their names, their date of birth, their residential addresses, their ID numbers, which might be like their social security number, documents of their images of their documents, like their driver's license or passport. There's just a ridiculous amount of information that you have to provide here. And it has to be filed within, for this year at least, within 90 days of forming the new business. Starting next year, all businesses all existing businesses then have to also comply with this. Now, there are some exemptions. So large operating companies, which are defined as any company with 20 or more full-time employees with a US physical office, and you file a federal income tax return with more than $5 million in gross receipts, you're exempt. It's actually a pretty small business, but it's got to be the and. So you have to have 20 full-time employees, and you have to have at least $5 million in gross receipts or sales on your tax return. So it's, you've probably heard the statistics, like our country is ran on small business, right? There's the handful of large businesses that, make the most noise, but it's the small businesses that are the backbone of the United States. So a lot of the small businesses are gonna be impacted by this reporting, and they're probably not even aware of it. The tricky part would be the ongoing reporting. It is not an annual reporting like your Secretary of State filing or your tax returns. There are triggering events whenever someone moves or their ID expired, you got to get a new copy of their ID. Something like that. Like now we've got to keep track of where everyone is at all times. That's quite the burden. So I'm curious to see how this plays out. This is really, like I said, brand new. It's effective for new businesses this year, but starting next year, all businesses need to be aware of it and be aware of if you're exempt or not. There are certain listed industries that are exempt as well. I didn't list them all, but those that are heavily regulated, like CPAs, right? Like we're heavily regulated, so we don't fall in that bucket. But otherwise, they're really just trying to keep track. Just trying to keep more track. I want you to leave it there. This all happens through FinCEN, and I guess that's it. Oh, sorry, one more thing. So right now, the grace period for reporting is 90 days from when you form your new business or any triggering event. Starting next year, it's 30 days. I mean, I don't even think I update my address with all my billings within 30 days of moving. So again, it's going to be a little bit tedious of trying to figure out how are we going to keep track of this. There's some tips that I've heard. It'll be interesting how it plays out. I wanted everyone to be aware of it. All right, and then April is going to actually take the next 2 slides.
So this one is our unclaimed property reporting. So actually on the California business tax return, there is a question that specifically says, if you have any unclaimed property that you did, report it to the state controller's office. Interesting enough, I worked at the bank for a long time, and yes, when an account would go, unclaimed for a certain amount of time, or a safety deposit box, we'd have to escheat it to the state, hand over all the funds or property. And the same thing is true with businesses. So if you have that employee that you filled out their last paycheck for, and they didn't ever come claim it, it doesn't just get to go back into your bank deposit. It needs to be, after 1 year of not being claimed, sent over to the state controller's office. Other things, like if you have paid a vendor and the vendor never cashed the check, that has a 3-year life. So after 3 years, if it's still not cashed, then those funds must be given over to the state. Each state actually has their own online website search for unclaimed property. So you can go onto California state website and you can just type in your own name to see if there's any actual unclaimed property from the past that comes up from anywhere. It's important to know that this is like a great reminder for your bookkeeping, is when you go and you do that reconciliation of your bank reports and you see those stale dated checks or keep coming up, that it's like, oh man, that person still has not paid, cashed that check. Well, after 3 years, you do have to report that or 1 year for wages, 3 years for other property, to report that to California and actually try to do your due diligence in contacting this person if it's valued at 50 or more, to get them to claim it. And then your second part is you actually then have to remit the property or the value over to the state for them to put on their unclaimed property listings.
So I feel like them adding this question to the California income tax return for businesses last year is sort of making it low-hanging fruit. If you're, and I imagine they've got target industries, that they're going to say, all right, these industries probably have a lot of these potential unclaimed property, and if they're seeing non-compliance, it's gonna be really easy for them to filter that box, right, and see who we need to start targeting. We've had clients audited on this in the past. There were clients that had a lot of cash, and so it was definitely more of a targeted industry. But I think if it's coming up, this is something they're going to start going after.
Another interesting thing is always before, we had our state disability insurance tax rate. Last year was at 0.9, and it had a wage cap. So their employees were paying, once they reached the $153,000 mark, they were capped. They didn't have to pay any more of the SDI or you as employers. So, but now that is uncapped and has increased to 1.1%. So, I mean, that's a huge increase because that can just keep going on and on now past that 153,000 in wages. There are self-insured plans that you could establish. You want to look into that to help defer some of those extra costs. Then there's a new tax credit for 401k plans if you have less than 100 employees. If you sign up for a 401k plan for your employees, you can actually get up to $1,000 per employee as a credit for having that new 401k plan. And then interesting enough, the military spouse retirement plan eligibility, I mean, being here in California, we do have a lot of military people and transplants, Camp Pendleton and such like that. So lots of times the spouse has to move constantly before maybe being vested in their plan or before they're even eligible to take part in their plan. So they have this special credit now available for employers who will make the retirement plan either 100% vested earlier or will let them contribute to it earlier. So you can get up to a $500 per military spouse credit for offering that for retirement plan. And another thing I thought that is interesting to know is for the last 2 years, businesses have been able to deduct 100% of business meals. And so we just noticed with now in 2023, that is limited back to 50% as it always was. So just so you know, going forward, you're back to your 50%. And it's kind of important to separate these out on your general ledgers because entertainment is not allowed at all. But it is 50% for California. So it's always nice when the clients, have these separate buckets for meals that are limited certain ways and entertainment that is only allowable on California. That really helps us out.
Great.
Well,
Perfect. Well, I want April and Jessica, thank you. A great way to get through mornings, and I think actually everybody stayed awake, so I think we're all good with that. John had a question in chat, and if other people have questions, please put them in chat, or you can use the raise hand button, and we'll call on you and unmute you. But John's question referred to the HVAC questions about the tax credit, April, and he asks, what are the requirements for the type of HVAC? I did a passive system that does not require electricity. There's no government stamp on this type of system. So are there details that the IRS has provided to help people give guidance on the kinds of systems or capital expenses that they can make to take that credit?
Yes, so we definitely don't know the answer to that off the top of our heads, but there is information that the IRS has put out for all of this to figure that out. So if you need help finding that, our email's at the end of the slides, they can email one of us and we can find that information for them.
Perfect, great. Any other questions that we might have for April or Jessica? That was a lot of information, and people, we have another 5-10 minutes if people want to ask questions.
I know for me, my favorite answer to all questions is it depends. Everything is so, you really have to drill down into all the nitty gritty. And even then there might not be a total clear-cut answer. So in the end, it's, sometimes what you're comfortable with and, what makes sense.
Jessica, I have a question that came up during your presentation of that last slide. In terms of the beneficial reporting requirements, is that through do we have a place where that's reporting is going to go through? Is it going to be the California Secretary of State? Where kind of is the process for that, and how can people kind of plan for 2025 in terms of the processes that they need to put in place?
where are my notes on that? I think it's through FinCEN. That sound right, April?
Yeah, it does. I think it's the same reporting requirements that people have to do when they have out-of-state banks. It's totally separately e-filed, but it's part of an attachment to the return, but it is like a separate filing to FinCEN is what it's called for reporting purposes.
So I'm gonna put the link in the chat. And then they also have FAQs there as well. And that's where you're gonna find like who do I need to include? For example, you're not gonna report minors. So if you have to report your children, as an example, you don't have to report your minor children, but at what point do you? So when we say, related persons, it's quite extensive.
Got it. And Jessica, I'll ask that question. I don't know if anybody else is in that. Will that apply to, is that just for profits, or will it apply to nonprofits as well?
Yes, because nonprofits don't have owners, right? So there's nothing really to report.
Got it. Just meddlesome officers, so it's all good.
True. Yeah. But no, they're exempt. They're one of the exempt ones.
Perfect. Other questions that we might have for Jessica and April before we sign off?
I see Brian has a question in the chat about going into a little more detail on the entertainment and meal deductions. So I just want to clarify, entertainment is sporting event tickets, theater tickets, golf outings, yacht excursions. These are all not deductible federally, but can be 50% deductible in California if it has a specific business purpose. Client meals, when you take a client out to a meal, now is 50% deductible versus the last 2 years it has been 100%. I think it was a COVID thing, trying to make sure people are getting out, going back into the restaurants and stuff like that, help out those businesses. So when you're taking a client out, you have 50% for that restaurant. Then you have your meals for your employees while they're traveling. Those are 50% deductible now as well, when they have the 100% for the last 2 years. And then you have like meals provided for the convenience of the employer. So like we come in on Saturdays, and in order to get us to keep working the whole Saturday through and not leave the office to go get a meal, they provide a meal for us during tax time. So that's also 50% deductible. But if you were an employer and you had a holiday party or a company picnic or employee appreciation, something like that, that is 100% deductible. That's why I say it's just kind of important when we look at your profit and loss and we just see meals and entertainment lumped together, we go, which one of these were for this purpose? Which one was for this purpose? Can we get a little bit better of a breakdown so we make sure we get you everything that we can for deductibility purposes? I hope that helped, Brian.
Any other questions that we might have, if you want to put them in chat?
It did help. Thank you.
Great. All right. Well, with that, again, I want to thank you all for joining. If you want to, we'll, or actually not when you want to, but we will send out to all of you a lightly edited version of the YouTube of this, as well as the slide presentations that were there. Again, that slide presentation in the email will have April and Jessica's email. If you want to follow up with any specific questions that you might have had that have been raised, or talk about the ways in which that Magnus Blue can help you. And again, I want to thank, oh, hold on for a second here. Just before we go, John had a question. Let's see, converting farm or business vehicles to liquefied natural gas and propane, is that considered a expense that would qualify under the renewable energy stipulations?
I'm not sure about conversions. You'd certainly be able to expense it, but if you're talking about the credits, I'm not certain that it would qualify.
Yeah, John, definitely email me and I'll pull up the reference guides from the IRS that will kind of break that all out so that we can get some more clear answers for you on those.
Perfect. Now, some of our agricultural companies here in North County, those are probably questions that are going to be important for everyone. Perfect. Well, again, I want to thank April and Jessica for their time. Thank you, everybody, for joining. And again, this presentation will be available later today. So again, thank you very much.
Thank you, guys.
PM.